Hello, everyone. Thank you for joining our webinar this morning. MX Data is proud to have Dan Jablons here with us today. Dan has worked with independent retailers for over 40 years, helping them with improving cash flow, margins, and turns through precise forecasting and planning. His solution is directly tied to all of our products here at MX Data, so integrating with what you already have is easy and fast. He has known our founder and CEO, Xavier, for more years than either will admit to, as one of the first techs in the retail pro world. In addition, Dan has had a lot of success as an actor, working on shows like Curb Your Enthusiasm, Pam and Tommy, and the most recently Netflix movie, The Outlaws. Still, his primary passion is helping retailers. Dan, please take it from here.
Well, thank you very much. Hi, everybody, and appreciate you all dialing into the webinar this morning or this afternoon, depending on where you are. But I'm excited to do this presentation and excited to join with my friends at MX Data. And like the introduction said, Xavier and I started in Retail Pro when it was version 2.97. So we've seen our share of Retail Pro over the years and have stayed friends for a long time. And so I'm really excited to work with him and with everyone at MX Data to share some information with you. You know, the key thing that we find in retail is how do we make sure that we drive more cash out of the business, right? It's really easy to get lost in things like, selling reports and gross margin reports and that kind of stuff. But at the end of the day, there's some key things you have to do to get more more cash out of the business. And what my hope is in today's webinar is that I'm just going to show you 3 simple things that you can do to start to drive more cash out of the business or into your pocket. So let me go through that. I'm going to start by first saying who I am. I've been with, like I said, been in the world of retail for more years than I want to admit to. We started Retail Smart Guys about 16 years ago now, where we're helping independent retailers with cash flow, merchandising, growth, et cetera, et cetera. But yeah, because I live in Los Angeles, I think it's law in Los Angeles that 1 out of 3 people has to say they're an actor. So I get to do that, but you'll see some pictures here of me with Larry David, and there's a picture of me in the movie The Outlaws. I wear that goofy suit, which hopefully none of you have in stock in your store. And then me with Ernie Hudson with the family business. So, but again, my focus today and most days is really how do I help retailers thrive in this or any economy, really. I mean, there's all kinds of discussions about what's going to happen in the future of the economy and stuff like that. There's always those discussions, though, isn't there? And I think that the key now is how do we do the things that we need to do to make sure that we're focused on the things that are going to create more cash in the business. So, all right, today's presentation is based on a book called Acres of Diamonds by a guy named Russell Conwell. And he tells business owners that before you start going external, before you start looking outside of the business to figure out where the cash and the profitability will come from, look in your own backyard because there are diamonds in your own backyard. This is especially true in the world of retail. Sometimes I talk to retailers and I say, where do you think your growth is going to come from? And I hear, well, I might add another location, or I'm going to get some more lines in that are going to be better for me, or going to hire this killer salesperson. You'll notice all of that, though, is external to the business, right? All the things I want to talk about today are all things that you can do inside your business, and today you can do them without having to add on other stuff or that kind of thing. And if you follow these, you'll find that there's a significant amount of cash available to you. Okay. All right. And again, this is not theory. These are not like numbers we made up in a conference room or something like that. These are actual stores that we're working with, and these are really their numbers and their results. So this is all possible for any retailer, I think, but these are real numbers. So there you go. Okay. But we got to be willing to do a few things before we start. First thing, we have to be willing to look at some key metrics. You know that old saying, you can't improve what you don't measure, right? Got to be willing to change. There's that saying too, right? If you do what you've always done, you get less. Okay, it used to be the same or less, but really, given what's happening with inflation and what's happening with the rising prices and everything else, you're going to get less. That's just how that goes. And you got to be willing to act, make a decision, and even if that doesn't work out, you can do something called fail fast, which is where you basically make a decision, see how it goes. If it doesn't work out, okay, we get out of it quickly, but let's at least go for it and try. But we have to try to do something different than we've always done, and we got to be willing to act and not get paralyzed by the data or the numbers. Okay. All right. So the first one I'm going to talk about of the 3 tweaks that we're going to make to improve some cash flow has to do with financial. Now, I'm not going to get too deep into like the world of accounting because nobody wants that. But I will tell you that there's just one area I want to just quickly touch upon, which is that when you look at the expenses to a retail business, you break them down into either fixed or variable expenses, right? Fixed expenses don't change every month, and the variable ones change based on how your sales happen, right? Selling payroll is the first one I'm going to talk about, and it's a variable cost. Okay, so I want to figure out like how do we actually make our selling cost um, uh, in such a way that it actually creates more cash and more profitability for us. Okay, so first let's figure out how do we calculate selling cost. It's the payroll divided by the net revenue. So let's just say you have an employee and the payroll for them for the month of January was $1,700. Okay, and let's just say that that employee sold $12,500. Then their selling cost is 13.6%, 1,700 divided by 12,500. Okay, now ideally you do this by sales associate and you do it weekly, but you don't have to do that. You can do it monthly, and you certainly can start with, if you don't have it, you can have uh, you can certainly do it at least by the store, right? But and I am a big fan of doing it by employee. But for now, we can just say these are the numbers, right? We're going to divide total payroll um, by whatever revenue they achieve. Okay. All right. So now let's look at an actual example. So we were looking at a store. Their total expenses were 42% of sales. A little high, right? But there it is. 23% were fixed expenses, rent and insurance and stuff like that, things that don't change. And then 19% was variable expenses, and 12% of that was their payroll. So we went, okay, what if I could lower their expenses from 42% to 40%? Okay, just 2% reduction there, 2% decrease. Take a look at what that looks like in terms of numbers. Okay, so here's the store. They were doing about $750,000 a year. Their fixed expenses were 172, and their variable expenses 142. So their profit before cost of goods was 435. Okay, we go, okay, well, how do we improve that? Same revenue, not looking to sell anything more. Same revenue, same fixed expenses. Why? Because they're fixed expenses, they don't change. But if I can lower the variable expenses from 142 to 127, okay, the profit before cost of goods drops from 430, or the profit goes up from 435 to 450. It's $15,000 in net cash to the business without having to sell another piece. Okay. And by the way, this is not that elusive profit loss money that your accountant talks about that you go, okay, well, where is that? Well, it's all over your floor probably, but this is truly net cash to you. Okay. Well, okay. So how do you do that? When you start thinking about scheduling and you start thinking about how you have employees here, you do better at scheduling. You figure out when do you really need them there. One of the great reports in Retail Pro is sales by hour, right? So you can really figure out, do I really need 3 people to open the store, and do I really stay open as late as I do, and do I really need as many people there that late at night? You know what I mean? So there's ways to tweak this and make it work. I'm not talking about firing your existing staff and hiring all minimum wage people. That's not what we're talking about. We're talking about just finding a way to reduce our selling expense a little bit by just 2%, that if you're doing $750,000 could produce as much as $15,000 in cash. Okay. Now, one store did even more. They added a productivity bonus to the store manager. They said, okay, what if you could increase revenues by 5%? We're still going to reduce our selling cost. We're still going to try to reduce our costs by 2%. Okay. But we're going to add to that a 5% revenue increase, which frankly, in this day and age, couldn't be that hard given that inflation right now, as the time of this recording, is trending around 3.2%. So getting a 5% increase in sales is kind of important. Okay. All right. So same number. The first 2 columns you've seen, right? Here's the original store. This is when we did the little decrease in selling costs. But now, if I add a 5% revenue increase, I go from 750 to 788. Fixed expenses stay the same across the page because they're fixed expenses. Our variable expenses drop to 127. Now they go up to 133. Why? Because I had a revenue increase, and these are variable. But even still, with the revenue increase and the reduction in selling costs, our profit before cost of goods goes from 450 to 481. Now it's $46,000. Okay, so two little tweaks right there. Just fighting for that, planning for and fighting for that 5% revenue increase while lowering our selling cost a little bit creates that much cash in the business. It's impressive, and it's completely doable. And this again is not made up numbers. These are the numbers that an actual store that we're working with actually did. Okay, so one of the homework lessons, or one of the homework things that you guys can do is, first off, figure out how to measure your selling expense, right? Take your payroll, divide it into your sales, okay? And then look at what a 5% increase might be for all of that, okay? So you can see how much cash you can generate, and that becomes a reason to do this, right? If we want to make sure we're generating some cash to make this all happen, okay? It's a good one though. The selling cost one's a really, really good, easy, fast way to try to develop some cash right out of the bat, okay? All right. Now the second one is markdowns. Now markdowns are one of your top 3 expenses, right? Besides payroll and rent. And learning how to manage the markdowns is certainly a critical part of what you want to do as a retail store, and certainly a critical part of what we're talking about here in terms of improving cash flow. Okay, so here's a different store. I picked stores for all my examples today that are around the same volume, just so it's apples to apples. Okay, so doing about 750. Their markdowns as a percentage of sales over the last year were about 21%. Again, kind of high, right? So they were spending $157,000 in markdowns, and their gross profit was 45%. So they generated cash about $341,000. Now we go, okay, what if I could just improve the markdowns by just 2%, drop it from this 21% that's here to 19%? With the same sales, just with a little less in markdowns, we spend, about $7,500 less in markdowns. Our gross profit goes up a whole point, and we generate, again, from 341 to 348, about $7,500 of cash improvement just by getting our markdowns a little bit better. Now, it's safe to say that you guys could all go, okay, yeah, well, thanks, Dan. Lower markdowns. Good tip there. Like, I don't want to do that every day. But, the key about markdowns, and the key to reducing markdowns, is to understand what causes them so you can mitigate some of those causes. And I've listed some of them here. But the important thing of it, or the way to think of it, is to group it based on sales markdowns and buying markdowns, right? If we look at the selling markdowns, like, why does that markdown happen? Well, maybe the salespeople don't understand why the product is there, don't like the product, right? Don't have enough product knowledge to actually sell it properly, to actually get get customers to be interested in it, right? The customer, takes it into the dressing room and leaves it there, and we don't actually go back and figure out why. Is it a sizing issue? Is it a fit issue? Is the fabrication a problem? The feedback doesn't get to the buyers, right? So all that's on the selling side of things. Do they understand it? Do they know why it's there? On the buying side, it could be because, look, there's no such thing as a perfect buyer, right? So sometimes you're going to buy something and you're going to think it's great, and your customer goes, yeah, not so much. We like to say the customer votes with their wallet, right? So if they didn't vote for it, we got to figure that out, okay? But maybe we had too broad of assortment, we didn't go narrow and deep, which is the way to make money in retail, is to go narrow and deep in the assortments, right? Maybe we, maybe the goods came in too late, so we didn't get a chance to sell them when they were in season. Maybe we didn't have a good DCS structure in Retail Pro, excuse me, so they didn't, we don't understand how to bring in the right goods and plan them the right way and that kind of thing, right? But if you take nothing else away from today's presentation, if you take nothing else away, look at this last line in red here at the bottom. It says, every time you sell an extra item, you avoid a future markdown. Well, there you go, right? There's the key to it right there. If I could get my salespeople just to add one more unit to every transaction, I would lower my markdowns. Just one more unit, right? That's all. But part of it also, I think, too, is you really have to have a strategy. You have to have a plan for how the markdown is going to happen. If it's random, it gets expensive. So I like to when I work with our stores, I like to tell them they should target that they sell through at least half of what they received in the first 30 days that the goods are there. Because if I do that, I at least know I can pay for the bill when it comes due, right? Now, I'll tell you something interesting about this in terms of sell-through and turns and that kind of thing. You guys all know the store called Zara, right? It's been around for a long time, lots of locations. The people at Zara will tell you that 80% of what they sell in any given month, 80% of what they sell in any given month are goods that arrived in that month. They keep it very fresh, right? And they're turning quickly. And they take the markdowns that they need to on a month by month basis to get those goods out of there. I know a lot of people have the point of view like, well, I only go on sale twice a year. That's all I want to do. And I'm not going to show markdowns all the time. And yet, there's ways to sort of work through that and sneak around that a little bit. Okay. But the main thing is that having an actual plan for what you're going to do in terms of markdowns is the key to profitability in this business. And it's certainly a key in terms of controlling and keeping your markdowns at that reduced by 2% number that we showed just a couple of screens ago. Okay. All right. The last one, which is most near and dear to my heart, is purchases. Now, look, inventory is your biggest expense. You spend more money on inventory than anything else, than on rent, than on people, than on technology, than anything, marketing, anything, right? So manicuring and curating your assortment is the key to profitability in retail. It's the most important thing in this presentation. It is the most important part of your day and your week. So if you're finding yourself spending a lot of time on things that aren't the manicuring and curating your assortments at retail, you got to rethink what your day looks like and get that all under control. Okay. You really, really, really have to make sure that's under control. Okay. All right. Let's look at an actual great example here. Here's another store, again, doing it in the 750 range, and purchases were about 55% of their business. So that means that they were spending about $413,000 a year. Okay. And we said, okay, again, what if we could just reduce purchases by 2%? What would that look like? Okay. Well, that means my purchases go from 413 to 398. Okay. So I actually, again, date another $15,033 in cash just by knocking down the purchases. It's a big amount of money, right? Okay, but that said, you can't just cut every single thing by 2%. Okay, you can't just tell people, okay, don't ship me a dozen, ship me 11. Okay, because they won't, right? You have to look at it on a class by class level. So there are certain classes that are in growth mode, and you want to make sure those are being fed and that you're feeding the growth in those things, that you're watching the trend in that. Classes that are not growing need kind of some maintenance. Like, why aren't they growing? Is my is my assortment not fresh? Do I not have new merchandise in there? Am I not really keeping an eye on how things are turning? I might keep doing some vendor scorecards in there to make sure the stuff is turning the right way, et cetera, et cetera, et cetera, right? And classes that are just falling apart and aren't working need to be dropped, and we need to figure out what was the money that we were investing in that and put that into the classes that should be fed. Because a sweeping cut across all of your categories is going to destroy the business. Okay, we need the fresh flow of inventory to make sure the business is growing and doing well. My Zara example from the markdowns thing is certainly relevant here, right? So we can't just make a knee-jerk reaction. We got to make sure that we're flowing the goods in properly every single month. Okay, well, how do you do that? It starts with a good sales forecast. Now, I spend most of my time focused on sales forecasting, and we're good at it. And the thing about sales forecasting is it's not last year plus or minus the percentage. We don't just go, okay, well, last year we did $750,000. We want to be up 2%. So, we're going to be, what is that? 730 or something like that, 780 or something like that. That's not the way to do it. Okay. You want to basically look at each individual category and forecast each one. Okay. And you want to do it based on what the current trends are, not just all of last year versus this year. Okay. And you want to consider not only where things are trending with you, but what's happening in the industry. I have a client, and they said to me, we just don't sell dresses. It's not what our customer wants. And I said, well, the reason you don't sell dresses is because you're not buying them, because they never received them. Well, the people on the floor don't think we can sell dresses really well. So I had to convince them to spend some money on dresses. It became the third best category in their store, right? So you have to consider what's happening around you and consider where that information comes from too, right? Forecasts really done properly are done by month and by location, right? So that you can evaluate them every single month. There are too many people that get their forecasts from their CPA, and then they go, okay, those CPA said it's going to be this number. I took that number in, I kind of thought about it for a moment, and then I went back to doing what I always do. Okay. If you forecast by month, You can also evaluate, is it working, which is why step 5 is there, monitor the results, right? Are we actually hitting the forecast we planned for? Because especially if we're buying goods months out and we're not hitting the forecast that we're supposed to be doing, we can end up stockpiling a bunch of inventory and not getting our cash out of the business, right? So we need to make sure that we're monitoring the results. So it starts with a really solid sales forecast, okay? After that, we have to then plan the inventory that we're going to need to have to hit that sales forecast, right? We do that with something called the stock to sales ratio, which has been around for a long, long time. It's basically for every piece I'm going to sell, how many pieces do I have on the floor? Okay. Now you also have to include some assortment planning in this. What am I, if I want to sell X amount and I'm going to buy this amount of inventory to hit that, right? How do I assort that by vendor? How do I assort that by color? How do I assort that by fabric? How do I do it by, how much is basic versus fashion? Okay. Um, et cetera, right? Size assortments, that kind of thing. You have to think about what does that look like on the floor. And I'm a big, big fan of going narrow and deep on that. Okay. That's the way you make money in retail, is not by having, everything out there. I tell this story all the time, but if you're a women's store and you put every blouse known to mankind up on a wall and said to your customers, you can have whatever you want, you know what they would do? They'd walk away. It's too confusing. It's too much. But if I have a nice narrow assortment there, right? My customer knows what I believe in as a store, and they know what to buy, right? I'm working with a store right now. They bought way too wide, and so as soon as they make a couple of sales, they're all broken up on the floor. They look like a garage sale, right? And the customer looks at it and goes, "I don't know what to do. It's too many choices." And because there's onesies and twosies of each one, it's easy to think I'm making a mistake or I'm buying the last of everything and I deserve a discount. But if there's a good chunk of goods in there that are there by each individual style, okay, now I know what I'm supposed to buy. I know what the store believes in. I know what believes in. I know what you believe in terms of price point, in terms of style, in terms of fashion, in terms of color story, in terms of fabric story, in terms of vendor story, right? So narrow and deep is the way to do that. So you want to basically make sure that you're flowing the inventory in there. So there's something new to talk about every single month, right? That's stuff to post on all your social media. That's stuff to do your email blasts with, et cetera, et cetera. That's where all that comes in. Okay. And again, you want to monitor the results. Did I do it? Did I bring in the goods that I thought I wanted to bring in? Did I actually create the assortment I wanted to create? Did I actually hit my forecast on all of that? Okay. Now, a few more things I want to talk about, and then we'll open things up to questions and that kind of thing. Okay. But here we go. First off, you have some great tools from MX Data to monitor the business. I find too often when I talk to retailers that all they run are selling reports. They go, why don't you run like inventory reports? They go, well, because they'd probably be wrong. And I always say, well, okay, here's the thing. If your inventory is wrong, right, you got to fix that. You got to look and see what's causing it. Because here's what I can tell you. Elves did not arrive in your store in the middle of the night and change the numbers in your point of sale system. Okay. If your inventory is wrong, it means we either received it wrong, sold it wrong, transferred it wrong, or counted it wrong. We did physical inventory. It really comes down to those couple of things, and you really have to isolate what's causing that, right? And fix those. And certainly the guys at MX Data can help you figure that out. But you want to figure out if your inventory is going off, why is that happening, right? If we've already established that inventory is your biggest expense, not having a great measurement of that inventory is really a problem. You've got to be letter perfect on that inventory. You got to know what is it, where is it, and how long has it been there, and what am I doing to sell it? Okay. Now, I'm also a big fan of sales versus receiving as opposed to just cost of the sales, which is cash margin. Let me take a minute and describe that. Okay. Let's just say you're working with a vendor and you buy $2,000 worth of merchandise from them at cost, and you're planning to put it out at $5,000, right? So $2,000 at cost, $5,000 at retail. Not particularly piggy on that, right? That's a fairly normal markup, okay? Which means my margin is supposed to be $3,000 on that, right? The 5,000 minus the 2,000. Okay. Well, now let's just say you only sell 3,500 for some reason. Okay. Customers didn't like it. You have to take the markdowns. You took one home for you. Whatever the reasons are. Okay. Well, that means that my cash margin is actually $1,500, right? If I only sold $3,500, but I gave the vendor $2,000, the net cash to my business, my cash margin is $1,500, not the $3,000, right? So you want to watch your cash margin because that's what's basically changing in your bank account. Okay. And cash margin could be how you evaluate your vendors. Okay. And we can talk about a vendor scorecard. There's one that we created for Retail Pro that we can certainly help you get. But you want to evaluate your vendors by a vendor scorecard. I could talk for days about the vendor scorecard, but it's the only way to really evaluate vendor performance is not just by gross margin, it's also by cash margin. Okay. Now, the point number 4 is for us what I like to call the low-hanging fruit with any retailer we start working with. Okay, and that is old inventory is not your friend, and so you want to go back and use that last receive date in Retail Pro to figure out anything you've got that's older than 90 days. Anything you got that's older than 90 days, you have got to take action to get your cash out of those goods. Old inventory is disruptive to your business for a number of reasons. Reason number 1, you've got cash tied up in it, right? If you've got goods that have been there for more than 90 days, that money is just sitting there and not doing anything for you. And it's money you can't spend on new inventory that you might want to do something with, or maybe you want to remodel the store or hire another employee, whatever. You can't because your cash is trapped in old inventory. Okay, that's number 1. Number 2, okay, it affects your marketing, right? If your customer comes in this month and sees what they saw last month, they're not coming next month. They figure they've seen it all. But to the degree that you can surprise them with new inventory and new exciting things is how you drive traffic on the floor. My mentor in this business was a guy named Mark Weiss, and Mark taught me that there is no better marketing for a retail store than having the right merchandise. And having the right merchandise means constantly having new and exciting stuff on the floor all the time. Okay. So that's, those the first one. The third reason why old inventory is bad is that it's disheartening for you, right? If you have something that's in your store for more than 3 months, more than 6 months, and I come in and I even express some interest in it, you still have to muster a whole bunch of energy just to get me to like this thing when you yourself are sick of looking at it for all that time, right? And probably the fourth and most damaging of all the other ones, besides the fact that you've got cash tied up in it, besides the fact that it affects your marketing, besides the fact that it's just hard to look at, right? Is this? Do you know that you pay tax on old inventory? It's true, you pay tax on it. Why do you pay tax on it? Because it affects your cost of goods. Your accountant will tell you that, right? So to the degree that you've got goods trapped in old inventory, not only is it tying up your cash, not only is it messing up your marketing, not only is it bad to look at, but you are right now paying tax on those goods. If that wasn't enough to get you to jump out of your chair and start looking at the old inventory, I don't know what will, okay? But you definitely need to start looking at what that old inventory is and figuring out how you're going to get rid of it, okay? And the last point on here is about expense control. And expense control is certainly important. We did some of that in this presentation, right? When we reduced the selling cost and we reduced the markdowns cost. And while it's important, it's not long-term strategy. It's not a plan for growth, right? When you think about that and you read in some business publication or business website or some article you get about a business that's doing really well, right? Who are they talking to? They're always talking to the people that produce the product, and they're talking to the people that market the product. They're never talking to the CFO who goes, "Oh yeah, I reduced shipping costs by 3%." Right? That's not where the growth of your business is going to come from. Okay, your growth is going to come from, yes, managing your expenses so you have a bit more cash to play with, but you've got to start thinking about what is it that I'm selling, how am I going to turn it faster, how am I going to drive more cash out of the business, and where do I want this thing to go? Okay, these are sort of important tips, I think, that make a big impact on your bottom line. Okay, now let's just go back and through the 3 things that we talked about today. Okay, um, we did 3. We did selling cost improvement of 2%. That got us $15,079. We improved our markdowns by 2%. That got us about $7,500. And then we got another $15,000 out of turning faster, out of improving reducing our purchases by 2%, right? So on a business that does $750,000, we created another $37,600 without additional sales, without having to fight for additional sales on the floor at all. Okay, it's pretty impressive, right? Kind of amazing. So think about that. Now you might be doing 1 or 2 of these already. I don't know. You have to look at it and see. But the truth of the matter is, okay, that by doing these little improvements, and 2% is not a big improvement in any of these, but by doing any of those, look at how much money you can generate. Look how much cash that goes into your pocket as a result. That's why these are worth doing, and that's why we call these diamonds in your own backyard. Look, I did all these without adding a location. I did all these without adding a vendor. I did all these without adding a salesperson. I did all these without coming up with some crazy marketing thing that people think is the answer to all this stuff. All of this was stuff that was done by making changes to things inside your business. Okay. All right. Now, I want to, before we get to questions, there's two quotes I think that are really, really important, and they're kind of fun to think about here. So I wanted to give these to you also. Okay. So this first quote is from Ben Franklin. It's actually in the forward of the Farmer's Almanac. You guys remember that from when you were in school and they made you read the Farmer's Almanac? Maybe some of you. Anyway, um, uh, in the forward to the Farmer's Almanac, there's a story that takes place in colonial times because Ben Franklin wrote it, right? And this will make you laugh, but it has to do with retailing. And in that forward, there's this story, and all of the retailers of this particular town are in the village square with their powdered wigs and everything, right? And they're all sort of flipping out. They're like, "Oh my God, taxes are being increased again. How are we going to survive these taxes? The taxes are going to kill us. I mean, what are we going to do about these taxes? They're just going to destroy our business. We don't know how we're going to survive with these taxes." So they turn to Father Abraham, the old man of the village, and they say to him, "Father Abraham, you've been doing this a very long time. You know what's going on out there. Okay? Tell us, how do we survive these taxes?" And Father Abraham says this quote right here: "We are taxed twice as much by our idleness, 3 times by our pride, and 4 times as much by our folly." What does that mean? We're taxed twice as much by not doing anything, by just going, "Oh, well, that's how it is." Okay. 3 times as much by our pride, right? That we just believe our own stuff. Okay. Okay. And don't actually look at the data. And 4 times as much by our folly, by our unwillingness to actually look at the data, look at the numbers, and instead of creating some crazy fantasized solution, coming up with real numbers and real data by this. Okay. And the other quote that's on here that I like is the one from Peter Drucker: "All good ideas degenerate into work." If you liked anything of what I said in these previous slides, those 3 ideas about reducing selling costs, reducing your markdowns, or reducing your purchases, okay, well, it's a great idea, but now it's going to take some work to figure out how do we do that. We got to calculate all that stuff. We got to come up with a plan for it. We got to come up with an open to buy plan that makes the most amount of sense to do all that. Okay. All right. A couple of things about Retail Smart Guys before I get to the questions. Okay, these are some of the services that we offer with our friends at MX Data. We do actually do what we call it planning, but it's basically open to buy planning for those of you that are looking for an open to buy plan. We basically help you come up with the industry's most accurate sales forecasting and therefore the sharpest inventory. Okay, but if you're also struggling with these other things like bookkeeping, we have bookkeepers that do it for less than what you're paying now for bookkeeping. I guarantee that. We also do PO entry for you. All of our the people that we work with are overseas, right? So you guys have heard of virtual assistants. We actually have a group of virtual assistants that we have trained in Retail Pro, so they can actually enter your purchase orders for you for less than minimum wage. Okay, and if you're doing social media posting and you hate it, you wish someone else was doing it for you, we could do that for you too. Again, less than minimum wage. Okay, but there's some of the services we offer there. Okay, and for being willing to sit through all this with me, you get a free hour with your Uncle Dan. Okay, what does that mean? It means I will connect to you. I'll run some of my own reports out of your Retail Pro system, and I'll help you figure out what departments could you be doing better in, where do you want to be performing, where could you get more cash out of the business. Okay, is your expense structure right? Are there things that we should tweak about that? And how could you take all the things that we talked about in today's webinar and invoke them in your store? Okay, so if you're interested in that, here's all my information. My website is there. That's my cell phone. Okay, feel free to call me anytime you want. And my email is there. And just so you know how crazy I am, I don't go to sleep at night unless my inbox is empty. Right. And the reason is because if you write to me, I figure it's not because you need a new chocolate chip cookie recipe, right? If you're writing to me, it's because there's something going on with the business and you need help. And one of the things that is the hallmark of Retail Smart Guys, and I think that we are super, super, super focused on, is making sure we are super responsive as fast as we can possibly do it. Okay. All right. So with that, that's my presentation. Let's open it up for some questions. And I hope this was helpful to you. But let's see if there's any questions out there.
All right, that was great, Dan. Yes, we do have a few questions that have come in through the presentation. The first question being, what do you recommend as a markdown strategy for independent retailers so that customers don't think we're on sale all the time?
Okay. I think the thing that you want to do on markdowns is, first off, they have to be targeted. They have to be planned. You have to anticipate, when am I going to do it and how am I going to do it, right? So, a lot of stores do things like, okay, if it's not sold, if I'm not halfway sold through 30 days, I'm going to quickly move that to the back of the store so it's away from my fresh merchandise, and I'm going to take some kind of markdown, 20, 25%, and then I'm going to look at it at 60 days, I'm going to look at it at 90 days, and continue to move through it. The key is to, first off, not broadcast it, right? Tuck it away in the back of the store, okay? And make it an afterthought. A lot of stores do a thing like they put a rack of things they want to put on sale, and they call that rack their, last call on best sellers, so that customers don't think, oh, it's just a brutal markdown. It's like, okay, well, we're finishing up with these, but let's see if there's something there that's interesting to us on that one, right? And I think also, part of the strategy on markdowns is, before you go to the, bloodletting markdown level, right? You might start by, there's things you can do before you take the markdown, right? One thing is certainly move it around on the floor, right? Maybe it's just got a bad location, needs to be someplace else. I'd put my salespeople's attention on it, right? Sometimes people give a little spiff to the salespeople. Hey, for every one of these that you sell that we're stuck with, I'll give you $5 extra, right? I don't want to turn my salespeople into mercenaries where, they only do things if I paid them, big chunks of commissions on stuff. But, sometimes that does help move stuff. And certainly I'd have a conversation with the vendor before I take my big markdown. I say to them, hey, listen, I bought this stuff and it's not working out. So what are we going to do about that? Because they may trade you out. They may go, yeah, that's not working for you, but let me put in something else that is working for you, right? The vendors want you to sell through on this stuff. They don't want you stuck with merchandise. So if you're having to put their brand on sale, it's bad for them too, right? So I would partner with them more than just what happens at the trade shows, more than just when they're selling you stuff. I want to partner with them for sure on everything we do, so that they understand how the goods have to sell through the floor, and that they help us get out of that. So those are the couple things I might do, but certainly I would be focused on when and how am I going to take those markdowns, and really doing it in target. Oh, the other thing about the markdowns too is, if I am going to do a sale, if I am going to do that kind of thing, I'm very big on a short period of time for that sale. I don't want to be on sale for a week. If I do a sale, it's going to be like, hey, this weekend we're doing it. It's a 3-day blowout, and bang, take your markdown, take your hits, just be on sale for those 3 days, and then sale is over, we're back to full price. Okay. Okay.
Okay, great. Yes, next question. Does the selling cost calculation include benefits or taxes?
No, the selling cost, a good question. The selling cost, which I should have covered that before. Selling cost only includes whatever your hourly is with them. Okay, do not include taxes. Do not include, the employer's contribution or their deduction of taxes, and don't include benefits. This is just purely, what am I paying them to be there, and what are they generating in revenue? Okay.
All right, the last question that we have come through. Given the economy these days, is your forecasting really reliable?
Yeah, actually, we've been working in yeah, I know people ask us that too. Sometimes they go like, okay, well, things are going out of control here. What do we do? And because our forecasting is all based on trended, but it's also using some stuff you guys have heard about called artificial intelligence, right? Artificial intelligence, by the way, I mean, it's very big in the news right now, and it's all kinds of crazy stuff happening with it and that kind of thing. Artificial intelligence has its place in the world, and I'm both a fan of it, and I think it also has to be controlled and kept carefully, because uh, um, I think artificial intelligence, is really good at certain things. It's really good at evaluating data. If there's a big enough data set for it to look at, okay, it makes conclusions, but those conclusions are only based on, like, just like us as humans, right? If you have enough information, you can make a good conclusion. If you don't have enough information, you make a bad conclusion, right? Our artificial intelligence stuff and our stuff works because we have the largest independent retail database on the planet, right? So, because all of the number of retailers that use our services, right? As a result, we see trends in the data and can forecast those really well. Since implementing artificial intelligence, our average forecasting accuracy is a little over 96%. It's a really good number, but it's not, just because we turn on artificial intelligence, we're constantly monitoring it, tweaking it, improving it, making it better, right? And to be fair, you know, our most accurate forecasts happen because people follow the plan we give them, right? If I tell you to bring in $10,000 and you bring in $2,000, you're going to miss the plan, right? You're not going to be on the forecast. Similarly, if I tell you to bring 10,000 and you bring in 50,000, you're going to beat the plan because you're better, right? If you want to stick around. So, it's sort of a build it, they will come kind of thing. If you stay close to our forecasts, they become very, very, if you do what the plans tell you, you're going to be very accurate on the forecasts. But again, it's based on trending and based on artificial intelligence, so it really works beautifully that way. Okay. All right.
All right.
Any other questions?
I do not see any other questions coming through, so I think we can just wrap this up. Thank you so much, Dan, for being here today and discussing everything. Everyone who attended, and if you haven't and you're watching this later, if you would like more information, please contact us. In the meantime, thank you everyone for attending, and again, thank you so much, Dan.
Hey, and I want to thank you and everybody at MX Data for letting me do this presentation. I really appreciate my partnership, and the guys at MX Data are great, great, great partners and really understand the point of sale business and can really help you with the kind of tools that you need to not only do well in your store, but do better than your competition and thrive and really have a successful retail operation. So thanks again to everyone at MX Data, and I look forward to seeing you guys soon.